You can reduce your capital gain taxes literally to zero, provided you understand how capital gain taxes are calculated on stocks, mutual funds, gold ETFs, bonds, etc. I've created practical examples that I'm going to share in this video through an Excel spreadsheet in a very simple language. And you will not find this content anywhere on YouTube or internet. So if you find this video useful, you can consider subscribing to my channel. With that, let's get this video started. What you see on my screen, first of all, is an Excel spreadsheet. We're going to start with Indian stock, then move to US stocks, then move to debt mutual funds as well. So first thing is Indian stocks. So from an Indian stocks perspective, I have taken 4 examples here, as you can see on my screen here. And I'm going to explain to you short-term capital gain, long-term capital gain, losses, as well as profits, right? So if we consider the first row here, you will see that, let us say, if you invested in ITC stock for 50,000 rupees and you made a profit of, let us say, 25,000 rupees, right? You held the stocks only for 9 months. You sold them in the March 2023, right? Now, if you look at this, the rule for Indian stocks is very simple. If you hold a stock for less than 12 months, then any gain that you have on that stock is qualified as short-term capital gain, and you have to pay 15% tax on the capital gain, right? So let's break it down. If you see in this example, we hold the stock for 9 months, which is less than 12 months, and we made a profit or capital gain of 25,000 rupees because we invested 50,000 rupees, but we got 75,000 rupees when we sold the stocks, right? So our capital gain is 25,000 rupees. On this 25,000 rupees, I will have to pay 15% tax, right? If we only consider this in isolation, but please do not worry, at the end of it, you will see that we can reduce our capital gain literally to zero if we understand all the rules, right? But let's just go to the second example we have here. Let us say you bought Nykaa stocks. Again, you held them only for 10 months. Last year, Nykaa stocks were doing well, but this year they have fallen down badly. Almost they have lost more than 50% of their value. So let us say some friend of yours or a chachaji of yours gave you an advice last year that go ahead and put 5 lakh rupees in Nykaa, and you lost almost 2,50,000 rupees. That's where I say, please do not go by others' advice. Do your own research always. Here you see you've lost 2,50,000 rupees. You don't need to pay any taxes on that, obvious, because there is a loss. But how do we offset this loss is what we will understand in the upcoming sections as well. But here, because there is no profit, there is a loss here, your capital gain tax is zero here, if we consider this line in isolation. Moving on to the third example where I'm talking about the mutual funds. So here I'm talking about the equity based mutual funds. So any mutual fund that has invested in equities or Indian stocks by more than 65% of their portfolio, they will fall under this category. So for example, you can take an index fund. I talk about index funds a lot. Let's say Nifty 50 index fund, or you can take a large cap index fund like Axis Blue Chip, or flexi cap mutual funds, multi cap mutual funds, small cap, mid cap. All these mutual funds are under this category because all of them invest more than 65% in the equities, right? Now, if you look at these two examples here, in the first example, Nifty 50 index fund, let us say you held it for 48 months because you're a long-term index investor, right? And at the time of investment, you had invested only 1,50,000, but at the time of selling the mutual fund, NAV was such that you got 2,50,000. So you actually gained 1 lakh rupees of capital gain, right? And in the second example here, let us say you lost a lot of money because you had invested, let's say, in Axis Blue Chip, and that has not been performing in the last 1 year. By the way, I've covered that in my other videos as well. But let us say you made a loss of 30,000 rupees because you sold these in the last year in June 2022, right? Now, if you look at the capital gain here, you would see that in the first example, which is UTI Nifty, you made a long-term capital gain because you held it for more than 12 months, right? Therefore, long-term capital gains are taxed at 10%, all right? So if you look at this here, 1 lakh's 10% is 10,000 rupees. So if you look at this line item in isolation, you will have to pay 10,000 rupees tax on this particular capital gain, which is 1 lakh rupees. In the Axis Blue Chip case, because you lost the money there, you don't need to pay any taxes. But again, I will talk about offsetting the taxes as well in the coming few minutes. Just to summarize, from an Indian equity or equity based mutual funds perspective, the rules are very simple. If you hold it for less than 12 months, you have to pay short-term capital gain tax, and that is taxed at 15% on your capital gain. While if you hold it for more than 12 months, then it is qualified as long-term capital gain, and you have to pay long-term capital gain tax, which currently the rate is at 10% of the capital gain that you have earned, right? Which I've explained to you in these 4 scenarios. I hope that was very clear, but if it was not, please go back and watch this video slowly, because it's very, very important for you to understand every single calculation that I've done here. Let us now move to the US stocks and how the capital gain and taxes are calculated on US stocks. So let us say you are an Indian and you invest in US stocks. By the way, I have not yet created any good videos around investing in US stocks. Please let me know in the comments if you would like me to start doing a lot of research around US stocks, and I will be happy to shoot more videos. But let us just come back here and have a look at how I have taken 4 scenarios, again short-term, long-term gains and losses. I'm going to explain. When you invest in US stocks, what typically happens is the rules are that if you hold a stock, US stock, for less than 24 months, which is 2 years, then you have to pay short-term capital gain tax, which will be as per your income tax slab. These taxes are levied by Indian government. They are not the taxes that are levied by US government, right? From a capital gain perspective, US government will not levy any taxes on your income on US stocks, right? Now, short-term gains up to 2 years are taxable as per your income tax slab, and long-term capital gain taxes, which are after 2 years, if you hold a stock for more than 2 years, then you will have to pay 20% tax with indexation. I'm going to explain, don't worry about it, very simple example, right? So let us just talk about the short-term capital gain taxes first. So look at Google and Facebook here. Let us say you invested in Google and you held the stock for 16 months, which is less than 24 months, 2 years period, and you gain 30,000 rupees in that, right? Since it is less than 24 months, it's a short-term capital gain, and you will have to pay tax on this 30,000 based on your income tax slab. So if I assume that you are a rich person and you are earning a lot of money, which I'm happy for you, you are actually paying 30% tax. So let us say you are paying 9,000 rupees here on this 30,000, which is what makes sense, right? Now here in, let us say, Facebook, because the stock is not done well, you have lost some money. Of course, there is no tax liability on that, but again, we will talk about how to offset it, right? Now let us talk about the long-term capital gain taxes. So first is Apple. Let us say you have held the Apple stock for 35 months, which is more than 24 months. Therefore, it qualifies to be a long-term capital gain. And let us say you had invested 3 lakh rupees, but you got 5 lakh rupees. So 2 lakh rupees of capital gain is what you've done. But you see here, I have only taken 1,56,000 because of indexation benefit. Let me show you and calculate very quickly using a calculator what does this indexation benefit actually mean, right? So let us say at the time of investing in 2020, the investment was 3 lakh rupees, and now you have sold it and you earned a profit of 2 lakh rupees. But please know that inflation has gone up in the last 2 years. Therefore, your 3 lakhs should not be counted as 3 lakhs today. It should be counted a little bit more as per the inflation, right? So there is a calculator. You can go onto website. You will find enough calculators. One of them is right here on my screen. You can see that if you purchase 3 lakhs worth rupees of any stock, in this example, we have taken example of Apple here, and purchase date was 2020. If you put these calculations here, it will say that total cost of that stock today is 3,43,000, right? Not 3 lakh rupees. Therefore, your total capital gain tax is not 2 lakh rupees. It is 1,56,401. Many people do not understand this and lose out a lot of money here. But if you put the right calculations, right rules here, you will not pay tax on 2 lakh rupees. You will only pay tax on 1,56,000 rupees. So if you calculate 20% on this amount here, you will come to at roughly 31,000 rupees. So with that, you can save a lot of taxes by just applying these normal rules, right? So summarizing the US taxes, very simple. If less than 24 months, short-term capital gain tax based on your income tax slab. If it is more than 24 months, it's a long-term capital gain tax, which is 20% with the indexation benefit. I hope US taxation is very clear. Let me know in the comments. If it is not, please watch the video slowly, go back, pause, and again watch it. You'll be 100% clear. Let us now move to the debt mutual funds. So far, if you're liking this video, please press the like button so that it reaches to more and more people on YouTube. With that, let's get back to the debt mutual funds now. So there has been recent changes on the debt mutual funds if you've been following the news. So debt mutual funds are the mutual fund categories where the mutual fund manager invests more than 65% of their money into the debt or debt instruments such as bonds, for example, right? Or government securities, T-bills, etc. Right? Now, if you look at the examples here, I've taken liquid funds, for example, will fall under debt fund categories, short-term debt funds, arbitrage funds. Again, there's a whole range of mutual funds that you can invest. I've created a lot of videos around good liquid funds and all that. With that, let's now get back to the debt mutual funds. And if you look at 4 scenarios that I've taken here, so let us talk about two main scenarios. One is if you have purchased debt mutual funds after 1st of April 2023. That is the two examples here that you see. From 1st of April 2023, the new rules apply. The new rules are more simpler. They are more tax heavy, but they're more simpler. Rule is very simple. Whether you make short-term capital gain, long-term capital gain, it doesn't really matter. You have to pay tax on capital gain as per your income tax slab. So here two examples I've taken here, and let us say you hold a particular debt instrument for only, let us say, 1 month or 47 months, it doesn't really matter. Let us say you've got gains of 10,000 rupees or 20,000 rupees, you have to pay as per your income tax slab. Here I've taken 30% of this amount here, and here as well I've taken 30% of this amount here, assuming that you are in the 30% tax bracket, right? Now let us talk about the debt mutual funds that you invested before 1st of April 2023, right? At the time, the rules were that if you hold a debt mutual fund or a debt instrument for less than 3 years, then you have to pay taxes as per your income tax slab. But if you hold it for more than 3 years, then you have to pay taxes as per the 20% with indexation. So let me show you that. First example is that let us say you held a particular liquid fund only for 3.97 months. In that case, you have to pay 30% tax on this because it's a short-term capital gain, right? But if you look at the second example here, you held this particular debt fund for more than 36 months. Therefore, you have to pay capital gain tax on this, which is 20% with indexation benefit. Again, from an indexation benefit perspective, let me show you the calculation. Let us say you invested 40,000 rupees and you sold it at 60,000 rupees. You don't need to pay taxes on 20,000. This 40,000 would have become in the last 37 months, it would have gone up. So if you do the calculations, again, use the calculator. I'll provide the link in the description. 40,000 actually became 45,000 because of inflation. Therefore, your tax will be on 14,187, not on 20,000 rupees. So if I come back here, that's what I've calculated this particular tax on, which is 14,127, 20% you apply. Now, debt mutual funds are very simple going forward from 1st of April 2023. Also, another important point that I want to make about is that international mutual funds such as Motilal Oswal, Nasdaq ETF, they all fall under debt mutual fund from a capital gain taxation perspective. Gold ETFs, they all again are taxable under debt mutual funds. Gold mutual funds as well. I've created separate video on gold ETF. If you've not watched it, please go and watch it. I'll provide the link here. Also, please understand that NPS has zero capital gain tax. I've created a separate video on comparing NPS versus mutual funds for your retirement planning. An absolutely important video. Please go ahead and watch it. You can save a lot of money because the capital gain taxes are zero there. Also, sovereign gold bond. I've not yet created a full video on sovereign gold bond. Please let me know in the comments if you would like me to, because there also, if you hold it for 8 years, the capital gain tax is absolutely zero. Let us now move and look at the another very interesting and very important rule, which is offsetting. What you see on my screen is the summary of the capital gain taxes that we've got here. If we just talk about the stock related capital gain and losses, what you will see is that in the short term, if I look at the short term summary, we had the gain, we had the loss. So the net, we had a loss of 2,05,000. If you look at the long term ones, we had the loss as well as we had the gain. Therefore, we eventually had 1,96,000 rupees of gain. The rule says that if you have lost money in terms of short-term capital taxes, then you can offset it against the long-term capital gain. So in this example, because we lost a lot of tax here from a capital gain perspective in short term, 2,05,000 rupees, I can offset it and I can bring this tax to literally zero, right? So in this example, all my capital gain taxes in terms of the Indian stocks or US stocks, if you look at this portion here, will be absolutely zero because of the offsetting rule that we have. But lastly, from a debt mutual funds perspective, as per the new rules, you do not quantify or qualify your capital gain taxes into short-term and long-term buckets. You will have to pay taxes. Therefore, the attractiveness of debt mutual funds have gone down slightly from 1st of April onwards, right? I hope you find this video useful. If you did, please press the like button. You can follow me for upcoming videos. Until then, I will see you in my next video. Keep rocking.